Okay, in this little worksheet, we're going to talk about the worksheet called Return on Invested Capital. So let's say that we've purchased a stock, and this stock costs $200 to buy a share of stock. Now, we can do one of two things. We can purchase this stock for $200 a share, or we can create a margin account with the brokerage firm. Let's say that the brokerage firm allows us, as the Federal Reserve allows, is that we only have to pay 50%. So if we have to pay 50%, that's the initial margin. That means our ownership, the equity portion, is $100 and the debit balance is $100. Let's change this just a wee little bit. Let me change. Let's assume that they'll only let us do a 60%. So that means we have to put up 60% of the money, 120. That means we've borrowed $80. This way they won't be even, and we'll be able to see this a little bit better. Let's say that on this margin account, they also tell us that we're going to have to pay interest on the money on this balance. So let's assume that the interest rate is 8%. So we're going to have to pay 8% interest on this balance for this particular stock. Let's say that we've held this stock for 4 years. Now this stock is currently worth, let's say it's worth $350. This stock has been paying dividends for the last 4 years. Let's just say it's paid, this individual stock paid $4 a year. So that means we receive $16 in dividends. So as you can see over here, what we're doing is we are accumulating and calculating the returns based on this arrangement with the particular brokerage firm. Let's say that the maintenance margin, again, this is the minimum amount. Let's say that they've let us go to 50% is the maintenance margin account. So if our margin falls to 50% or below, they're going to do a margin call on us. So let's look at what's happened for this company. The return on invested capital is 117%. Now that doesn't include the time value of money. So we need to incorporate that into our analysis here. So the currently maintenance margin balance is $100. We have the annualized return on invested capital is an average of 29.25%. And if we include the time value of money, it's 21.37%. The return that we would have without the margin is 70%. So we would have actually, if we would have done this free and clear, paid all $200, we would have made 70% on this investment. The current margin is 77%. You can see that's far above the 50%. So the amount required for a margin call, you see here it says negative $95. If this is negative, what it means is that there is no margin call. So what would happen if the price, instead of going to $350, what would happen if the price fell to $175? At $175, again, you can see that the returns have changed, obviously. We have negative returns. And the current margin is 54%, which is still more than 50%. We have a formula down here, or a cell that says this is the stock price that's going to trigger the margin call. So if this goes to $160, you can see now that we're exactly even. So we would now have there's no margin call, but anything less, we're going to have a problem. So let's say it goes to $140. At $140, you see the current margin is 42% and we need 50. So we're going to have to pay $10 to bring this account back into the margin so that we can ultimately so that we can maintain this account. Now, the company will decide what to do. If this is a large enough account, right? If this is just one share, but what if we bought 100 shares? This is obviously everything multiplied by 100. They could essentially just sell a share of stock to get the $10, or they could take it from our cash account. But one way or another, we're going to have to come up with $10 to cover this margin call. So again, this is the return on invested capital. It allows us to look at what happens when people borrow money in order to invest in stocks.